the super high barrier to entry markets with high rent growth, Seattle being one, certainly California being another, northern New Jersey, South Florida. Those markets are very strong. A lot of people are pushing pause on some of the Midwestern markets that don't have the same dynamics.
Good day, Industrial Advisors listeners, and thank you for tuning in. If you have not subscribed, please do so by clicking subscribe wherever you podcast. Click the like button and hit the bell if you want notifications of when we put up new content. Leave us a comment about anything we discuss here today or general comments about the show. Now, let's get into it.
Welcome to our Industrial Advisors podcast. You have Bill Condon and Matt McGregor, and today we have Mike Kendall with us. Mike leads our industrial investment group on the West Coast for Colliers, and we've teamed up with Mike on many occasions. He does a great job, and today we're going to talk all things capital markets and West Coast capital markets and the current state of what's going on in that world. So, Mike, great to have you with us today. Appreciate you taking the time.
Thank you. Thanks for having me join.
Yeah, welcome to the show. And Bill, you forgot he's an Ironman. I mean, you got to throw that in there.
Yeah, that's right.
That is kind of a big deal, isn't it?
That is a big deal.
That is a big deal.
Yeah, maybe the first Ironman we've had on the show.
Oh, look at that. All right.
Very good. Mike, thanks for joining. Tell us about, I mean, it's been a strange year, obviously. Everybody's aware of interest rate hikes and changes in capital markets, but tell us about, what's going on the West Coast in general. What markets are hot? What's the overall activity like right now?
Well, good question. Yes, it's been a crazy year, frankly. Really started to disrupt in March of last year. So it's coming up on, just now a year. And, things were very, very disrupted in towards the end, the fourth quarter of last year. And one of our busiest times for doing valuations is October, November, getting ready to launch in the new year. And we were dead. I mean, we literally had zero valuations going, and we were not alone. All of our competitors were saying the same thing. And then all of a sudden, towards the middle of December, right before the break, and into the first quarter of this year, valuations have gone through the roof. I think we've done 30 valuations in the last 2 months. And, that to me, I think some of that is owners trying to put their finger in the air and trying to figure out which way the wind's blowing. But some of it is actually, I think, owners realizing that the bottom is not going to drop out of the market, that things are not going to get a lot worse. People were kind of waiting for that other shoe to drop, and they've acknowledged that industrial is holding up very well. And so now they're ready to transact. And there are a lot of groups out there that have executed their business plan. They're merchant builders, built buildings. Maybe they're not going to make as much as they would have a year ago, but they bought the land 3 years ago, and they're going to do a lot better than they pro forma'd. And so they're ready to transact. And there's other groups out there that are looking to kind of right size their portfolio and want to prune a little bit. So that part is good. Right now, today, there's very little product on the market because of that phenomenon where I was talking about nothing was valued in the fourth quarter, nothing was ready to bring to market. Now, I believe there's going to be quite a bit of new product coming to market in the next couple of months as these valuations start to filter through the system. On the buy side, we have noticed a noticeable uptick in investors calling, saying they're off the sidelines, they want to invest. Now, that doesn't mean they are going to invest.
Right.
That's the first step in that. But I guess time will tell if they back that up with actual submitting offers. But I'm cautiously optimistic, I guess is the best way to put it. We have put a couple things in escrow off market, kind of off market offers with groups that were definitely on the sidelines last year. So that feels pretty good to me.
Do you think the bank failure last week, what kind of implications do you see there?
Yeah, so I was going to say, up until last week, I was definitely noticing an uptick in optimism and a downtick in pessimism. With Powell's comments, and then with the bank failure and the jitters, I guess I should say, in the financial system, is definitely going to cause some more people to maybe pause before they get back in the market. So I
Right.
think there's going to be a lot more uncertainty and just, kind of, again, sticking a finger in the air, figuring out which way it's going, the wind's blowing.
Yeah,
A little early though to
yeah.
figure
Sure.
out what that's going to look like.
Yeah, speaking of uncertainty, when Matt and I got into the business, long-term leases were looked upon as being favorable, right, for investment properties, and we've seen that obviously shift where investors are way more aggressive with leases that are expiring in, call it, 2 to 3 years. Do you think that shift is going to change and go back to more stability being favored again, or do you still think that the kind of shorter term walls will be looked upon as being more favorable?
Well, I guess the way I'd answer that is, as long as rent growth continues, this has been historic, the rent growth that we've seen in all these markets. And because of that, that's shifted the focus to the shorter term leases, because you can get to that value much quicker. And the rent growth combined with the interest rate rise has made that short term wallet attractive. As long as we have sustained longer term interest, higher interest rates, it does make that longer term wall challenging. And
Mhm.
when I say that, you know, no one's going to take negative leverage for 5+ years, or I should say probably 6 years. I have seen some people take it as much as 5, but when you get
Mm-hmm.
to 6 to 10, it's just too hard to take negative leverage. So again, right now, I guess it also depends on investor profile. One thing I will say is, one change that I've noticed, and this, you know, has been interesting. So a year ago, risk didn't really matter. Risk was not being priced properly, in my opinion. You had bad credit, good credit, priced about the same. Bad location, good location, secondary market, primary market, everything kind of priced the same, because there was so much money to get out and discipline was gone in the underwriting. And now the pendulum has swung probably too far the other way, where risk matters and risk is probably being overpriced. And so we are seeing, credit matter again on leases, and there's going to be a pretty big difference in cap rates with credit versus non-credit. Maybe that will shift that WALT discussion a little bit further as you get, as credit matters and stability matters. Maybe that's going to start to change, but it hasn't yet.
Interesting. Yeah, on that note, Mike, why is it that short-term walled is attractive, say 2 or 3 year leases, but vacancy, like as in a forward speculative building under construction that was so hot a couple of years ago, why isn't the aggression there? You can immediately get to it. So tell us about the difference of a forward or vacancy versus that short-term wall.
Well, we are seeing interest in forwards in select cases. It's
Okay.
not, definitely off the table in markets like where there's no constraints to supply. So definitely off the table in Dallas and Chicago and places like that. We are seeing some interest in forwards in some of the Western markets where there is some structural barriers to new supply. The difference between now and a year ago is, forwards a year ago almost priced as leased investments. There was very
Mhm.
little spread. It was just trying to get to the real estate and not have to compete once it was leased. Now, people want a spread to a stabilized investment. So if you have a seller that is willing to meet that market, we'll see some forwards transact. But that's a good question. I think the reason is, the next there's just a lot of uncertainty over the next year. Versus 2 or 3 years out, people think things are going to settle down again. So I think if you had something that had a WALT of less than a year with a bad credit tenant in place, you'd probably see the same jitteriness. If you had a good
Mhm.
credit tenant, you would assume that they would renew because there's low vacancy. Then you'd probably see some interest there.
Yeah. Well, let's talk a little bit. You've touched on it, debt, and how that's impacted the capital markets world. Do you think things are going to settle down on the debt side and stabilize here in the coming months?
Well, we were starting to see it get a little more liquidity coming back in with the new year, fresh allocations of capital with the lenders. The money center banks weren't active yet, but the life insurance companies definitely were. The regional banks were. They were choosing their spots. They were being very selective, but industrial is definitely the favorite asset class. And we were seeing, even though rates were not coming down, rates were continuing to go up very slowly, the spreads were starting to come in a little bit. So we actually saw a little relief in the cost of debt in January and February. The thing that's been challenging has been the proceeds. It used to be that you could get a 65, 70% loan to value, and now you're 50 to 55%, in some cases less than 50% loan to value. And
Wow, big
as we all
difference.
know, equity is a lot more expensive than debt. And so that has been probably the biggest challenge. And when you look at it on the construction debt side, it's even more exaggerated. You could get a construction loan, 75% loan to cost a year ago, and now it's 50 to 52%. And that rate, again, it used to be sub 4%, and now it's 8.5. So big difference. That's why you're seeing a huge slowdown in construction starts. It's just, people don't have that much equity typically. So the land values have been hit even harder than building values have been.
Mike, you mentioned this earlier that you're starting to see an uptick in calls and overall activity. I will say after a very quiet, say, 3 quarters last year, not in volume, but as far as people coming up and calling us and saying we're ready to place money, the last 2 months have been crazy with inquiries, people coming up looking to get in our office and talk about the market, saying they're back. Do you expect a big surge later this year based on that and overall activity on the West Coast?
Yeah, I mean, I'm going to caveat it with, what's happened last week with the bank.
Mhm.
That's a big shock to the system, and
Yes.
and really depends on how the federal government responds and how the market responds.
Mhm.
So, kind of taking that aside for a minute, if we had this discussion, 10 days ago, I would have said, yes, we expect this to be the mirror image of last year. Last year was definitely front end loaded, a really strong first half and a very slow second half. I expect it to be the opposite. We're expecting to see a pretty slow, drop in volume, certainly first quarter, second quarter, but an uptick, pretty big uptick in the second or third and fourth quarters. And our pipeline is kind of following suit. We are packaging 5 deals today, that we're going to launch in the next 3 weeks. We have another 5 deals that we're waiting to hear on. So we could have as many as 10 deals in the market in the next month,
That's great.
which is, I think, a sign of kind of what the second half is going to look like.
Yeah, I would agree with that. That we are starting to see, and Matt alluded to this, a ton of more groups saying, "Hey, we want to place capital, we're comfortable." And historically, we'll look at it, and we'll probably look in the first half of this year. The numbers won't be great from a volume standpoint, but I envision the second half being pretty strong. So you would agree with that, Mike?
I would, and in addition to leading the West Coast team, I also sit on our national advisory board for capital markets, and I'm the industrial person on that. And I lead our calls every month for the national platform. And so I have a bit of a national perspective, and it's easy to get kind of jaded out west. It's not the same everywhere. And the super high barrier to entry markets with high rent growth, Seattle being one, certainly California being another, kind of the four corners, northern New Jersey, South Florida. Those markets are very strong and attracting the dollars. A lot of people are pushing pause on some of the Midwestern markets that don't have the same dynamics. And so we should be thankful that, again, we live where we live.
That's right.
Mike, what do you think about land value in core markets on the West Coast? I'm talking LA, Phoenix, Seattle, maybe Vegas, core markets, large pieces of land that, historically very hard to get, heavily sought after, bid after. If something came to the market right now, what is there a decrease in value over, say, a year and a half ago? And how many bidders versus a normal situation?
Great question. I have a very, very good real-time example
Great.
to illustrate that. We took to the market 29 acres in Vernon which
Mhm.
is about 8 miles from downtown LA, a super infill market. Some of the dynamics, the city of Vernon owns its own power company. So manufacturers, cold storage users, food users love Vernon. It was an old Farmer John pork process facility that they have been shutting down. So took it to market. It had an unsolicited offer early last year, first quarter last year. They went into escrow. I'm not sure it would have closed at that price, but the price was $225 per land foot,
Wow.
which was an all-time high,
Yeah.
Yeah, I
which is
guess.
crazy when you think about it.
It
Yeah.
really is.
And so that was $285 million for a 29-acre site. That's just for land,
Man,
obviously.
that's
So
insane.
we took it to market, went through our managed bid process, and given the scale, given the disruption in the market, we knew, because it was irreplaceable, that we would get interest. We just were pleasantly surprised by the amount of interest. We ended up with 12 offers initially, and we could have had more, but we were pretty firm in our guidance. And we ended up, getting it down to 4 groups that interviewed. And then we had to go through several rounds of bidding after the interview because people weren't separating. They were all clustered, kept moving the price up and up and up. And we're, well above $200 million. And we picked a buyer last week. And at the end of the day, we're going to be about between 20 and 25% below the peak. If you call that the peak, I think it's actually going to be more like 15 to 20 because I don't think it would have closed at that price, even back then. So the way I put it, if you have something unique, a large site in an infill market, something that's entitled for a 1,000,000 footer, even in the Inland Empire, which is, becoming infill, but then prices are probably down 15 to 25%, I would say. If it's a commodity land site, you could build a 100,000-foot building in a secondary market. Lots of those available. The value deterioration's been more like probably 30 to 45%.
Wow. Okay, great.
So big difference in,
Yes.
again, commodity versus something unique.
Absolutely. Well, Mike, I want to thank you for being on the show. It's a pleasure having you on. You're phenomenal what you do. We love working with you. For the listeners, we're going to have some stuff coming out with Mike in a bit. We'll put his contact information in the show notes. If you have something to sell in the western regions, please reach out to Mike. We appreciate listeners tuning in. And Mike, thank you so much.
Thanks, guys. Always a pleasure.
Thank you, Mike.
See you guys.
See ya.
Thanks a lot.